All right, so a big news day today. Most of it coming after the market close, but you got the FOMC, and another reason why the market's been very sideways. That pattern actually continued today, leading up to and through the FOMC meeting. But then we got the big barrage of earnings after hours. Facebook, Apple. They're all going to lead, what could potentially be a little bit of a breakout out of the sideways move. Most likely to the upside, as we've been kind of expecting when we talked about in Friday's market outlook last week. So we'll see if that ends up being the case. But until then, very sideways action. That's a very popular pattern, not only in the market on the short term, but also on a lot of previously really bullish stocks on a more intermediate term. So our trade idea takes a look at a stock. We've done a lot of trades on those types of stocks, and we do another example of that today with our trade idea of the day. So let's go ahead and get started. Today is Wednesday, April the 28th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off talking like we always do about the S&P 500 with the market forecast indicator. We ended up closing at the lows of the day after the FOMC announcement meeting, press conference. I guess there wasn't much of an announcement, but a little bit of an upgraded economic outlook, I guess you could say, from the policy statement. And you can see again, like I said, but very small range after getting a new high again today, immediately after. Very, very small range. So take it with a grain of salt, especially with the earnings that we had coming out after the bell. Facebook and Apple all coming out after the bell. So the intermediate posture, market sentiment, still strongly bullish. Market sentiment line is at 81.5 there. Near-term line's dropping, as you can see. That's not surprising. It is a 1, 2, 3, 4, 5, 6 days now. I mean, that's 7 to 12 is your typical run. So that's this is a typical near-term run. Again, that's atypical. This will rally. This is more typical, especially when you're coming off such a very long one. Momentum line still oversold, which means we still have an intermediate confirmation signal on this, which is typically a short-term bullish signal. It's a better short-term bullish signal because it can launch a new near-term run if you got the near-term line also down below 50, but we're not quite there yet. So if it does get us up, again, off of these lows into tomorrow, which there's a really good chance considering how bullish some of these earnings have been for some of these stocks, at least immediately. We'll see by tomorrow morning if they stay this strong. Then we might get maybe another day or two of a near-term rally. I don't expect more of these big long near-term runs now. Again, 6 months along, or going on 6 months along. Just expect really short near-term rallies. I still think we might get another one or two coming out of this before before we're really susceptible to more of a drawdown. I don't think we're quite susceptible to that yet. If I draw all these Fibonacci lines, that's a little bit of a longer upper shadow than we've seen, and that was the longest upper shadow we had. This is a little bit longer, so take that for what it's worth, especially with a much smaller body than what we had there. But then when you look at it this way, that doesn't look very long at all, right? And it's very small, but we typically don't get long upper shadows at the end of bullish moves. The VIX is really low, and you just don't get that. You don't get long upper shadows. You get long lower shadows at the end of bearish moves. That's more typical, higher VIX. So something to keep an eye on there. You can see the NASDAQ has not broken its new intermediate run yet. It's still above the 23% retracement, so still pretty noisy. The momentum line did fall to an extreme low, though. That's something, a little bit of a concern there. The near-term line also falling. It's a bullish intermediate confirmation signal, but it's weakened by how extreme the low point is. The near-term line down is below 50, so that near-term run is over, according to that. So any new bounce we get off of this bullish short-term signal could get us a new near-term rally up to new highs. I actually expect that will actually be the case. Again, especially considering the immediate reactions to some of these earnings announcements. And then finally, the Russell 2000, which obviously is not impacted as much by these earnings announcements. It's got that bullish breakout, but it's just not really taking yet because it's just really going sideways. Obviously, did not close at the low of the day like the S&P did. So still relatively bullish. Still got a good near-term peak here. You can see now we are we got to 46 in that day. So we're only 5 days into this current near-term rally. It is a higher near-term high than we've had the last couple near-term peaks. So we'll just kind of, it is a bullish kind of breakout there, but it's just not being confirmed yet, as you'll see by some of these other technical indicators, that we are indeed breaking out of this sideways action. So in other words, we're still very sideways on the Russell. I mean, we've been very sideways for multiple expiration cycles. That's been very good for us on IWM and our options inventory trading. At some point, that's going to break out one way or the other, and we'll see. It's a very tight range too. So we'll see if this is indeed the breakout to the upside, and that will eventually be confirmed by some of these other indicators as the market forecast tells us or suggests. Because again, the intermediate line not only got above the market sentiment, but it's also up above 60. So the market forecast suggests that it could be. We just don't have the green line to go with that dark green shading quite yet. That's how slow the upward move has been. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today, and it tells us that you want us to do another video again tomorrow. If that's the case and you like our videos and you want to let us know, you can do it with one click. Of course, if you don't like our videos, you don't have to click on anything. You don't even have to watch. But we do really appreciate the thumbs up. We check those out every video. It kind of gives us an idea of again, these free videos, whether or not you want us to keep doing them. So if you like them, let us know. One click you can do right now. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Why should other people watch them that are coming to check us out for the first time? Post all those in the comment section. Join our website on marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Among the things you get for free is access to our Market Outlook forum, our message board, where you can be able to interact with other market scholars who watch these videos every day. Follow me on Twitter. There's my handle right there, at DavidSettle42. I'll post things in between the videos there. And then join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, click on our Market Outlook Live. Again, if you're interested in reviewing all these old trades that I do in the Market Outlook to see whether or not we should stay in them or get out of them, check out that video there. That's where we talk about those things. I also already put on today's trade idea before the market closed. I do that during the live video too. Again, every day I do the Market Outlook, I do a live video at 3:30 Eastern Time. You can access it here by clicking on that image, or anywhere on our site. Just mouse over Market Outlook there and click on Live Trade Review. You can see our Q&A sessions that we do for premium subscribers, as well as all of our trading rooms over here under upcoming events. All of our paid subscribers, our monthly subscribers and our premium, get access to the Market Outlook live videos as well as the trading rooms. Of course, our premium subscribers get access to the Q&A sessions as well as our class forums specific to each class, and all of our premium tools too. Come down here to the bottom, click on that heart. It opens up a new tab. Hit that like button right there. Also, you can do the same thing here. Click on that thumbs up for Facebook. Again, you can click that like button there. The more you do that, that helps us out because more people will see our content, more than just 105. Again, the more engagements there are, whether you like and comment or share, the more Facebook will promote our content to all the people that follow our account, which is a lot more than 105. It also benefits you because Twitter does the same thing. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. Okay, we are a couple days into this new week and a little bit higher, so a new high, and obviously a higher close, and no lower shadow. Again, very bullish candle. The NASDAQ composite also has a very bullish candle, though we don't have the new high yet. We do have a higher close, no lower shadow. The Russell 2000 gave us a new bullish candle that we haven't had for a few weeks, so we've been transitioned. We're up above the 50-day moving average. Again, very high PPO levels, so keep that in mind. That PPO, just to recall, if I were to bring up the PPO, just because it looks like we're down from the highs, and that it does look really nice. But if I were to go out here to the max that we've had, and let me throw on a horizontal line here, and I'll do it at 13.52 there. Let me get rid of that line. So if you look at where we're at right now, all time on the S&P, this is as high as we got in March of 2000. So at the peak of the NASDAQ bubble, the Russell 2000's momentum, long-term momentum, got to the highest level ever to its current level now that it's pulled back to. So don't think that, oh, we've had a good pullback here, we can get a new rally up to maybe a new high. No. We're already really darn high. We're at the 88th percentile, but all the other 12 percentiles are these dots right here, right? So this is still a very, very high level. Needless to say, the S&P 500 is also very extremely high. Let's see, go back to 9.01. So we are above the 9% mark now, which again, that's higher than we got here earlier, right before this little weakness we had at the beginning of the year. So very, very strong momentum that's only been seen in the late 90s. So 75th percentile, but here, it's actually, I have to get rid of the pre-1957 where we had less than 500 stocks. This is where we had 500 stocks, and now we're in the 94th percentile. So 9% gap between the 50 and 200-day moving averages. Have been, that's a really, really high level, needless to say. So very strong long-term momentum across a lot of these. I've shown you these charts before, whether it's a 5-year linear regression that we're up over 1 standard deviation. So COVID has a much bigger impact on a 5-year regression chart as it did get to that, 2 standard deviations down. We are up to 1 standard deviation. But now once you get past 5 years, we are on nearly 2 standard deviations on the 10-year chart, and then of course on the 20-year chart we are outside of 2 standard deviations, well outside, closer to 3. So very, very bullish moves on the S&P 500, very strong. Whether it's the S&P, whether it's the Russell, which is 2 standard deviations, nearly 2 standard deviations away, or whether it's the NASDAQ, which is also more than 2 standard deviations away. Needless to say, all these indexes are very strongly bullish, riding very strong long-term bullish trends, and that's great. They can maintain good, strong bullish trends, just not to the same pace that we've seen, right? So we're not going to get 1-year returns from today going forward. We're not going to get 1-year returns here. Let me switch this to if I can click the right button here. We're not going to get 1-year returns to the levels that we've seen, right? We're going to start dropping. We're still at 60%, which is still just insanely high. It's again, one of the highest levels that we've seen. And this is the NASDAQ, where it's, the NASDAQ got really, really high here. But this is where we're at right now. You go back, there's our 2009 coming off of those lows, very strong moves. And there's the 2003 coming off that a strong bear market move. You can see we didn't start going down once we got to 60%. We just kind of went sideways with some up and some really choppy marks there. Here, let's just go max available on here on the daily, and then you can go back even further into the 90s to late 90s. There's the 98 and 99 where we stayed at 60+% 1-year returns windows for quite a while. But even once we got to this peak here, again, this very sideways action, by the time we hit over here October, once we got to that peak, 1-year returns later were 0% or negative. Once we got to that level, so we still had a very strong move to the upside, but 1 year later, right? And that was at when we kind of hit that peak there. This was actually October, early October of '99 when we hit the highest 1-year returns of 115%. We hit them again over there, and then of course. But again, looking at this level where it already looked like we were pretty strongly bullish, we had a really good return going forward. But going into October, you can see that we still had some pretty decent returns. But by mid-November, when we were kind of in the middle of that run, right at that point right there, we really kind of broke out. It looked really good, very parabolic. 1 year later, no returns, right? So, here we are. We've had that big spike over here. We had that big spike actually right there is where we had the big spike. So off of the highs, we've made a good bullish move since then. But now the question is, what are we going to be a year from now? Whether or not we're going to have positive returns or not, it's going to be dependent upon what that next exhale looks like once we actually do get it. And you can see again on SPX, the high that was the highest 1-year return above 70% that we've seen. Go back to the late 90s here. We didn't get 1-year returns. The highest 1-year return we got there was close to 50%. So needless to say, that's an extremely high number there that we have, that we peaked there, and then have since come down to 46% despite the rally we've had. So that kind of puts into context where are we going to be a year from now compared to that peak. You wouldn't expect that we'd be up very much. So we'd be closer to zero. So which means we have up and down moves still left to go. The question is, what's the down move going to look like once we have it? And then how long will it take before the next upward move gets us up to this new high? And I expect fully that we'll go up past this high. It'll just be a lot slower, in my opinion, than this little rally has been coming off the COVID low point. The VIX will be coming down from a much lower number than what we saw over here. Really quickly, let's take a look at a few other charts. The RSI and the CCI for the S&P still staying in bullish territories, but kind of grinding. Not necessarily the case for the Russell. We're not getting that breakout up above 60 there. You look at the directional movement index for the S&P 500, still very strongly bullish and rising ADX to a pretty strong level. Not the case on IWM. No trend at all and no confirmation of this little breakout because the negative index, the positive index is actually going down, bouncing down, and they're both below 25. They're both in between 20 and 25. And then finally, from a trend strength standpoint, S&P very strong trend. That's obviously slowing. And then you can see the IWM with no trend at all. Very weak and a very flat cloud there, which doesn't really offer very much support whatsoever. Now let's take a look at the intraday chart. And you can see the very, very small range we had today. A very small range yesterday. Then the green dotted lines, the day before that was even smaller. So, this whole week has been most of the range you can see has occurred right around the point of control. Talk about very top heavy on the volume profile in the last 4 weeks. It's all the volume. It's all in this area, pretty much all in the last week's range. And we're trading in a very small sliver at the top of last week's range. That continues to be the case there. IWM looks a little different. It's been a little bit more of a bullish move here, but you can see same sideways action now. Also at the top of the 4-week range now that we've got a new high in the low tags over here. That low tag, remember, tomorrow is going to really move. So the Arun indicator for tomorrow is going to, that red line, well, the red line already has, so that's reflecting the change now. That it's really moved up here. We saw that over here too, but we just had a much lower positive. Now it's up again, and a really strong high note. So that's not very bullish. It's not very bearish either. As you can see, we had a very similar where we had a high level on the green line and a high level on the red line, and you can see it kind of led to a bearish sideways action. So as these two lines start to come back down, you would expect that we'll get a very similar type move there. At least that's kind of what I expect out of the Russell 2000. If you take a look at today's volume and trading range, again, with the FOMC meeting, let me look how small the volume has been all 3 days. 50 million shares at just over 2 points yesterday, under 2 points. The day before that, under 1.5 points. So very small ranges. Very small moves, back below 1% on the ATR to price ratio. Very low volume, very small ATR, 3.8 points. So today's moves have been half of that ATR. And you can see volatility also, without getting a whole lot of movement on the volatility here. You can see still just grinding all week long near extreme lows. So despite the little rally we had, and despite being at 17.5, with the idea that we could break 15 and really be bullish, it's going to be hard, as I talked about in class today, it's going to be hard for the volatility index to go below 15. Other periods of time where the VIX has crossed below 15, and I shared some examples in class, when we crossed below 15 in the past, we've been crossing below 90% at the same time. Well, we're not crossing below 90% now because we're already at extreme low. So that's probably going to keep us above 15 until we get our next volatility jump. I don't even think it'll be a spike. It'll be a spike up to 115%, I think, here. But again, it doesn't happen from down here. It's a stair step up before we get this spike. Usually we'll jump from 90 or 95% up to 100, 105 or higher. So we need to form a new low point in this area first, in my opinion, before we can expect this big spike to the upside. So to summarize the technical outlook, just because we're not getting new not 75% 1-year returns going forward from today, it should be a lot smaller than that. Doesn't mean that we won't get bullish returns in the next week or two. In fact, I still kind of think we'll get some very grinding near-term runs while we kind of peter out here. You can tell that we are running out of gas from a bullish standpoint. We've had a good bullish run. It's rounding out. You see a lot of stocks rounding out. You'll see an example of it today in our market outlook as well. I know a lot of our class trades have been on stocks like today's trade example. So you see a lot of that, but we don't see enough catalysts to necessarily create selling. So it just leads to sideways action at worst, like we're seeing on the Russell, or grinding bullish action like we're seeing on the NASDAQ and the S&P to different degrees. So, and I expect that will actually continue at least over the next week or two. What do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggests why you're either a lot more bullish or a lot more bearish than I am, and share those with our community of market scholars that watch these market outlook videos. All right, that brings us now to what's driving the price action. Again, over a very, very tight window. Let's take a look at this whole week so far, and you can see commodities are still the big story. Like the big, huge moves in commodity prices. That's the storyline right now, and that's the problem that we're seeing in these inflationary discussions. Small cap stocks have actually had a pretty decent move. Again, most of it coming overnight on Sunday night, but holding those gains and then adding a little bit to them over the rest of this past 3 weeks. And bonds continue to fall. The little rally post FOMC, so the nice little jump in bonds there. But still, it doesn't offset the loss that we had over the past 2 days going into the FOMC, which is a rise in yields. So when you take a look at what that looks like here on this chart, you can see the 10-year yield having a nice little bounce, enough to bring the intermediate line up, but pretty much bouncing off the 38% retracement of that big long-term. Let's have to show you the long-term. This big long-term move right there, that's the 38% retracement line that we had broken up above. So it appears to be using that for support. I don't think that will last very long. I actually expect, we did have dark pink shading and red line flirting with it. So I actually expect we'll roll over more, at worst down to about this 1.15% level. That's where the 50% retracement is. That's where the 23% line is of this longer term run. That's kind of where I expect that we will fall down to, as long as TLT makes its way off of the moving average here and we get a bounce off of short-term sentiment, we start to rally back up again. That's kind of what I expect that we'll see get back above that 23% line where gold is, right? Gold has been pulling back a little bit. Nice little rally at the end of the day today. A new near-term low point here. Expect new near-term highs off of, considering we've had higher high, I expect a higher high coming off of low, low, low. And this low is where that 23% line is. So I think, you can kind of see the quote-unquote safety trade and how it's trying to get a start to it. That what's not the case for the dollar. The dollar continues to fall. The euro's, look at that move higher in the euro over the past few weeks. It's really gone from, the low point of that cluster of clusters, but the lowest point of that cluster, kind of this fake out breakdown, because this is where we thought it would get to, right? But then we had one more day of this fake breakdown and this morning star candlestick pattern to get back above the 78% line and then all the way back up. And again, remember, breaking above the 23% line now ends the retracement, right, and gets us going again on a bullish run. Obviously, we have dark green shading and green line right now, but that just gets us up back to the 23% line. Getting above that leads us to a new bullish move, right? A longer term trend, which I do feel like is coming. I don't feel like we will get it on the current run, though. I think that we'll probably peak here. I didn't even think we'd get that high, but it looks like there's some strong resistance there. Last time we had a big long upper shadow. We'll see what it looks like this go around, but I think that that's kind of where we'll peak before the dollar turns around, considering how far above the moving average we are, and works its way back at least to the moving average, if not back below it, as the broader risk off move takes hold. Obviously, it hasn't taken hold yet, and partly it's this really risk on move that we're seeing, especially like in commodity prices. Commodity prices did get a pullback to the 23% line, was unable to really get going, too far below that. Brief periods of dark pink shading and a red line, but has gotten up to this higher level. And if you look at it from an RSI and a CCI standpoint, big time divergence setup on the CCI, and you can also see too on the MACD and the stochastic indicators. The setup, the divergence setup on the histogram that you generally always see, but when you get these higher highs on the MACD with not higher highs in the histogram, then that generally is. It's one thing to get lower highs with your lower peaks on the MACD as well as on there, but here we're getting higher highs with a lower high in the histogram. That's generally a divergence pattern that we want to kind of keep an eye on these as well. Again, would fit inside of this risk off mode if there's any kind of breather on this really hot commodity index as well. All right, now let's take a look at the sector moves over the same time frame. Again, just in this past week, you can already see one big mover just off with your eyes there. But if you look at the big move today was in energy stocks, really breaking out early this morning. Financial stocks doing well too. Those have been the two biggest winners over the last so many months, over this 6-month rally that we've been on in equities. From that Halloween low point, these have been the two biggest winners by far, and they're kind of exerting some new leadership here with weakness in XLK as well as these safety trades. That weakness in XLK will be short-lived, as I expect that will pop back up pretty sharply tomorrow if Apple is able to maintain its gains and then offset what we've been seeing in Microsoft, and Microsoft turns back around. Real estate still holding up. It's the stronger safe haven asset class right now. All the rest of these small cap sector weighted areas, or small sector weighted areas, not small cap, but small sector weighted areas in materials and industrials, they're all outperforming, but very, very minimal gains. You can see XLC doing very well there. Google and Facebook are going to have a strong impact on that with earnings over the last couple of days. Going into tomorrow as well. So I expect that they'll continue to lead that up higher. But to show you what the rotation looks like, you can see the strongest momentum right now is in energy, not surprising. Materials, so very weak dollar related moves right there. Those sectors are the most dollar sensitive areas. And then healthcare obviously is the strongest momentum. Real estate's got some really strong momentum too, and has strong. In fact, it has the strongest relative strength. XLK, despite its loss of momentum, still has the second strongest relative strength. And then you can see XLY or XLV has got the third. So healthcare and real estate are two really strong sectors. They continue to show that strength. XLK has been the strongest sector. It's lost some momentum, but not enough to change the trend per se. And like I said, should probably start to kick back up here and show a little bit of rotation. As you can see, XLU is moving down to the left. XLP is over here in the lagging quadrant. Those are your safety trades. Those are the areas that will move up to the right once we really start to lose. One other thing too that stood out to me: very low trend today. Less than a point. It's been that way for quite a while. It's brought the 20-day average down to lower levels while we've been bullish. That will open up because usually it rises when you start to get bearishness, right? And so we've had a really, really high level going into that peak there on April the 16th that we had on the markets that we're kind of flirting with now, right? That on that day when we were rising, the trend was really high, which means very weak leadership. Since then, we've been pretty sideways, and the trend's coming down. Now, generally speaking, when you get a move higher in the trend, especially over 20 days, then that generally coincides with bearishness. You also see the relative strength line for QQQ and IWM is pulled back to the moving average, giving us with indicators that are at low ends of bullish ranges. So there's an opportunity for this to bounce. And we've talked in the past that a long-term move in this will more likely start with bearishness in equities, not so much bullishness like we saw on that first thrust to the upside where the Qs led higher. And again, that move led to a really high trend. The next move up in the trend won't be because everything's going up led by a handful of stocks. It will be because everything's going down, and the best performers will be the QQQ. Those stocks will hold up better than the XLFs of the world, the XLEs of the world, the XLIs and Bs of the world, because they have a poorer margin of safety if and when there is any more significant catalyst to actually do more than just trade sideways. All right, as you can see, our trade idea is a very popular pattern across a lot of stocks right now. Very strong bullish moves that end up with sideways action. You can see that as well here in the PPO for Uber. Very, very high levels, above 20%. Now it's still very high at 15, but is grinding as we're grinding sideways. It's trend strength indicators were also very strong and now are not so much. Very noisy patterns after a very strong trend. You look at the Bollinger bandwidth, and we've had high bandwidth levels before on this strong move. And even here recently, we've had a high bandwidth, and we've really been grinding down to the low end of the bandwidth range, stuck in the middle, right around a good strong volume node above the value area. So that kind of helps to keep from the downside move. You can also see we did have a high ADX there too, and then since then nothing, right? The ADX is really it's flirting with dropping below 10, so very, very sideways action. I don't have to worry about bearishness. I don't really have a whole lot to worry about bullishness either. So it sets us up for doing a little bit of a sideways trade. So if I come over here to the options, here we go. If I come over here to the options for Uber, I can sell a put at the 20 delta. So sell the 53 put, buy the 51. Sell the 20 delta on the calls too. A little bit, this has changed since we got into it, but sell the 65, buy the 67. So you can see I've already done that. We did in the Market Outlook Live. So here's the trade and what that does. And you notice I didn't do a full position size because I was able to get a typical return for that I generally am striving for with $1,000 of risk. I got that return for less than $700 of risk. The reason why is because there's earnings coming up before the May expiration. So if we do get a significant move in one direction or the other, then my risk is a lot less than what it normally is on an iron condor where I don't have to worry about the earnings, right? But remember too, any significant move will be offset by a strong drop in volatility, since this is a pretty negative Vega trade here. There you go. There's my Vega is actually higher than my delta is. So a strong drop in volatility will actually really help smooth out any significant moves. Like that purple line, if volatility drops, that will keep the purple line up, which is on my profit line. It will keep it up despite the stock moving in one direction, sharply in one direction or the other. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Remember, all of our subscribers, our paid subscribers as well as our free subscribers, have access to that forum. So open up any new threads there with any talking points that you have, or reply to other people's threads, and let's keep this conversation going in between videos. As always, remember to subscribe to our YouTube channel, hit that thumbs up icon on YouTube, as well as like us on Facebook and Twitter too. Comment on the video. Again, thank you for watching. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.